So you're thinking that Miami is going to be building and is going to be ready for the reset when New York is going to be having people essentially exiting Miami?
Listen,
Exiting New York, I'm sorry, to go to Miami?
I 100%, listen to what's happening. Cost of capital is extremely high. Fed came out today and said they're unchanging the rate. It's not bad news,
But it's not good news.
but it's not great news because we've been shitting our bricks for the last 18 months. Insurance has gone up across the board by 30%, not just building insurance, car insurance, COIs for contractors has gone up. So that's our cost of labor. Materials have gone up. Buildings have gone up. The renters have ran away. The buyers are on pause. We're transacting with like of 100% of New York has now become 60%. And the 60 could become 30 and we're in trouble.
And I'll tell you one thing. Let's talk about transacting. There's transacting in non-distress and there's transacting in distress. I think it's safe to say, at least from my point of view as a litigator, as a restructure professional, restructionist, a bankruptcy restructionist, in court and out of court, lenders are still trying to squeeze the borrowers. They're not giving discounts on the loans. But I don't think that's their fault. You guys don't want to know the truth about why the lenders apparently are not writing down their loans, because they themselves apparently have investors that they have to answer to, and they can't modify the loan by taking a write down on that loan. So what they're doing now is they're not allowing the market to breathe, even with a borrower that is in default. And I'm not talking about technical default, as you've stated previously, actual default. They've failed to make a payment. So we're sitting at a mediation and the lender's like, no, I'm not going to take a discount. We're like, well, the market is in the shitter and the interest rates are up. He's like, well, I'm about to raise interest on you. I'm about to take it back. So I think we're hearing it from all corners.
I think that's a good point. I'd love to hear Bob and Richie's opinion on this, right? You're talking about the capital side, right? And what people didn't realize is that when regional lenders stepped out of the game, credit funds stepped into the game, right? They could make their spreads. Interest rates are rising. There was good money in it. I'm talking about high teens for first position debt on construction financing.
Crazy.
And what we learned was when you're a regional lender, right? You're a bank, you're federally regulated, and you have to mark to market your loans annually, which wind up for when Bob will tell us about what he's selling. You can actually sell those loans at a discount because you were taught to take your hit annually.
Correct.
When you're a credit fund, which is everyone who filled that space, you are a hedge fund. You are a fund that's raised capital from investors. You promise those investors a return. And the structure of that joint venture, much like real estate, may be that there's catch-up provisions, meaning that you can take a part of your profit annually, right? The interest that comes in.
Right.
But if, God forbid, it doesn't go the next year and the profit fades, you, the operator, are coming in with money. So you're not motivated as a credit fund to discount the loan. You're motivated to pretend and extend, even if that's not going to happen, because you don't want to show your investors that you have a loss and you don't have to come up with money.
So just like Sarbanes-Oxley was passed to really temper the banking institutions, I think the private institutions, and this is really a democratic value, and we're not going to get into that today, but it's a democratic value that we should regulate the private institutions, and that will resolve our problem. Because if lenders had to take a discount and losses that were covered by the government, just like we've seen in 2008 financial crisis, a portion of the debt that the financial institutions gave out was thereafter covered and insured by the short sale modification program that came out, where if you were, you had a property that was $200,000, that was worth $100,000, you would short sell it, you would dispose of that asset as a consumer, as a borrower, and they would give you $100,000 basically discount, and the government would basically eat it and give you eat the cost. I don't know. Is it a good idea to have private institutions? And this is probably very controversial, but I'm still going to ask about it.
I got to step in here, guys. I'm going to blow this podcast up. I'm going to give you guys, which was once a secret, is no longer a secret after this moment. Developers don't get stuck. Banks take losses. You know what's worse than not making money?
What?
Not collecting it.
Right, but I'll tell you something. There's some.
If a bank says you owe $5 million, you took a $5 million mortgage, you have a 5-year term with a 5-year option to extend, protruding to the fact that it has to be same LTV, debt service coverage ratio. You give them the same rent roll with a 2% increase over the course of 5 years on average. You gave them expenses that have slightly increased, and they're telling you, hey, on your $5 million, you got to make a margin call. We need you to put $1 million into the equity. If you tell the bank no, developers, real developers, they don't get stuck. 99 out of 100 real developers, now there's not that many, they know how to renegotiate the terms with the bank to properly tell them, my friend, if I tilt, you coming with me.
Right, but they have their personal guarantees in the loan.
Yeah. No, not that I.
They got to collect. They have to absorb this asset. Let's not talk about $5 million. Let's talk about
Yeah,
something.
philosophically, I get it. If,
Like,
if
we're
you
talking
owe
about-
$5 million to the bank,
$5 million
they
is-
own you. If you owe $5 billion,
Let's talk
you
about
own the bank.
Let's talk about
But, like,
one developer that has high liquidity with the bank, 20-year relationship,
Tell them to call me.
20-year relationship, and he's done nothing but take and give loans, take and give, and now he starts to expand in 2018, 2019. He buys 1 lot, 2 lots, 3 lots, 4 lots. He puts plans into place. COVID happens. He survives COVID.
Yeah.
And he takes 1, 2, 3, 4 loans during 2021 when the interest rate or Fed was at 5 points. And he absorbs $250 million one shot. Now the bank is like, oh, it's a good developer. He's got good personal guarantees. Now I'm not talking about the other 30 or 40 clients that are experiencing the same problem.
Right.
What, are they going to let him default? If they let him default, they're defaulting. And you know what's worse than showing that they're investors? The institutional banks and the publicly traded companies that have to report quarterly earnings and they have to go to the Fed Reserve, they need to show them they're going to take a loss. For every dollar that you withdraw, they need to put in 8.
I appreciate that from your mouth to God's ears, I guess, about how a lender should cooperate and how a lender should negotiate. But that's not what I'm seeing in this litigation and mediations and arbitrations. What I'm seeing is the lenders are playing really hardball. And they're basically saying, we will modify it. We will put the interest on the back end. We will extend the terms of your loan. But we're going to give you a rubric of which to follow. And it's going to be our rubric. But because if you don't agree to follow our rubric, we're going to file a receivership application and take the property back until you either behave or we take the property from you. So I disagree. I think
is there a difference between different types of lenders? Are money center banks behaving differently than SNLs or is the foreign bank behaving differently? Are there differences of different categories of lenders?
Absolutely, 100%. So I had the Bank of India, okay, which you can bleep it out, but whatever. I'm going to say blowed up their spot. Bank of India was extremely cooperative. Okay, you give them a call, and their attorneys are extremely cooperative. Then you have, Madison Realty Capital. Okay, they're a bit more aggressive. They're a bit more astute. They're going to really rate their risk with this borrower. And then there are other private funds which have a very different attitude. They'll literally look at the papers. They'll see their borrower not doing well, and the next day they'll default them on a technical default and try to take their property, because lenders are also human at the end of the day.
It's actually very human, more human than your perception of it is. They are literally looking at the credibility of that borrower,
Right.
whether they're truthful, how they act as a reason
Right.
to make the decision, right? Because
Right.
think about the lender's position, right? It's discounted that the total cost is the lender's position. There's many things that you can do before it's their issue.
Right.
And they just want to see your credibility. Have you done this before to get paid back? Because nothing that happened in the past means that it's going to work for the future, but that is how that they look at each of their borrowers.
And I'll tell you one thing, Bob. You are correct to ask that question, but I think a better question to ask is, how? Yes, Leo, the lender's temperament is different depending on the actual lender. but also the borrower's temperament is different with each lender as well. So it's a two to tango. It's
Who's playing
not
offense?
one.
Who's playing defense?
Yes. And right now, if I were to suggest, because I represent a lot of developers, the who's who in the market of New York City, Brooklyn, Queens, Manhattan, and what I've been finding is they're laying a very, very tough attitude of against their lenders.
Yes.
Why? Because they're like, look, it's not me, the borrower. It's not you, the lender. It's the market or it's the government. And the lenders are not listening. They're saying, okay, you took that risk. I'm not your partner. And then when you get into mediation and arbitration and litigation, they're like, well, could you give us an equity kicker, 15, 20%? Let us get the upside and we'll discount here and we'll discount
Yeah,
it
but
there.
they don't want to be. Listen, developers don't want to be developers in this market. Banks don't want to be developers or landlords. They don't have the management systems and processes in place. They don't want to take your property and finish it. They don't know shit about construction.
But why are they being so
You know
aggressive
what?
then?
I just want to be clear. You have to be careful with that because there was a very famous company called iStar Financial. That was a lender. Guess what? It took every asset, became a developer, and killed it. So you got to remember, these guys are also
Out of how many?
I'm just saying you have to know who your lender is, right?
Yes.
And just, so there's a difference. You're right. Certain people, you can leverage that and state that. And I agree with you, but not all of them.